All right, folks, that's the top of the hour. Just a couple of quick housekeeping items before we get started and really deep dive into all of this fun O triple BA stuff. We are NASBA sponsor 168500. And in order to get your credits, you have to be logged in the entirety of the time or the entirety of the presentation, and then answer all six polling questions. And trust me, the polling questions should be fairly easy, so there's no pop quizzes. And with that, I'll go ahead and just start diving right into it. So today's webinar is Federal Tax Reform under the OBBBA, Strategies for Cost Segregation and R&D Credit Optimization. I am Eric Tuthill. I am a tax director and a CPA here with Corporate Tax Advisors. Prior to joining up with Corporate Tax Advisors, I ran my own firm, my own practice. And so the way that I like to look at this and digest it really is from what I hope is your guys' perspective, right? And how you really want to talk to your clients about a lot of these things. What's the need to know kind of components? Because obviously we have big stacks of tax law, and it's always hard to know all the ins and outs of and every little detail that's out there. But what we really need to know for the most part is what we call red flags, right? Or things to look into, a little bit more deeply as you go through the process. So the way that I like to look at it is from that perspective, and that's how I kind of couch and frame a lot of the topics themselves. With that being said, we'll go ahead and kind of go over high level what we're going to try to cover today. So the first thing that we're going to do is we're going to go look at section 41, the research and development credit, and we're going to do a little bit of a dive on just what the R&D credit is. That way we get to kind of up to speed and understand how it has been applied in the past, how it's currently being applied, and how it will be applied going forward. And then we're going to talk about specifically the OBBBA changes to the R&D credit, and that should also be shown. We'll also be looking at the cost segregation and the OBBBA changes, right? So things that influence our planning opportunities and how we're going to end up looking at things going forward. So I'll just go ahead and start with this first section here, and we'll go ahead and start with the first polling question. So I'm going to go and launch that out there. And like I said, you guys will have to answer all of the polling questions in order to get the CPE credit today. So I will leave that up here until the next round, and we'll just keep going through this. So the first topic is Section 41, the research and development credit. So a couple things about how this credit kind of worked. It was established in 1981 and it was permanently codified essentially all the way in January 1st, 2016. So they kept going back through and adding it every single year, and just they kept adding it and adding it and adding it, and finally they decided to make it permanent, right? One of the cool things about it is it's not a deduction, right? It's what we call a tax credit. So it's a dollar for dollar tax credit or tax liability reduction. And I don't really need to tell, I think, you guys a lot about what that means, but for the most part, it's going to be a lot, instead of a tax affected deduction where we multiply that times like a percent of our tax effect of 30%, it's actually just going to be the direct reduction of liability. The one cool thing here is we have a statute that allows us to go back 3 years. So if we hadn't touched it, especially in light of what happened with the OBBBA, we got the opportunity to go back there from a statute perspective. It's 3 years from the filing of that particular tax return that we can kind of go and do a look back on. And that's really relevant when we look at what happened with the OBBBA as well, right? So, I mean, if there were opportunities that were missed, we still have the opportunity to go back there and grab it because they made a retroactive treatment to specifically to the R&D credit, which is opening the door in a lot of good ways. One of the great parts about it is it can generate immediate cash flow, right? Minimizing tax liability, especially if we're doing a look back. You can get it. I mean, it depends on the size of the firms. It depends on a lot of things, right? But I mean, you can go back and essentially get a lot of money fairly quickly, and you can use that to fund your business and do a lot of different things, right? Or the taxpayer can do a lot of this kind of stuff. And of course, the intent, is kind of reduce the high cost of labor. And the eligibility that it's open to is all across the board, pretty much, right? Almost any and all businesses, any Schedule Cs, any S corps, C corps, personal service corporations, partnerships. ESOPs probably not so much. It doesn't necessarily preclude them, but that is a component to kind of think about when you think about this, because most ESOPs are tax exempt, right? So this is a common thread that we hear from a lot of taxpayers when we're talking about the R&D credit, right? And a lot of things that they hadn't really looked into it before, like a lot of their concerns, right? Say we don't necessarily document our work, we don't track our time, our customers pay for our projects, our activities are not innovative or groundbreaking, we're not profitable, we are an S corp or a partnership. This will be too time consuming. This will trigger an audit. And, as of late, it had been Section 174. We'd heard that quite a bit. There's a lot of reasons why most of these are not necessarily applicable. And it's really funny when you think about it as we go through this process, you'll see kind of a lot of the reasons why a lot of these companies are still qualify and still will actually get the R&D credit, if they work through the process. And there's a lot of people that don't even think, from an industry perspective, that it's applicable to them. So here are reasons to take the R&D credit. If we have a merger and acquisition coming up, you want to make sure that you got any and all tax liabilities kind of figured out. It will also help fund mergers and acquisitions to a certain degree, depending on the level of the credit and a lot of other stuff. If you're pretty profitable, and you are taking like, one of the things I always like to think about is like, if you're not taking advantage of all the credits that are out there and all of the deductions that are out there for your business, you're disadvantaging your business in the marketplace. And I know a lot of taxpayers have been in that same kind of situation, right? Where they're just not fully taking advantage of the things that are around them. Like, I mean, and if they can pick those up, they can hire more people. They can do a lot of different things that they might not have had necessarily been able to do because they're paying the tax man a little bit more. It's kind of funny because we're one of the only tax systems in the world where, you figure out what you owe. And they like to leave a lot of things on the table because then they get a little bit more revenue out of it, right? So some basics here, what is really calculated here is what we would call qualified research expenditures. So those are amounts that, we spend through this four-part test, and I'll go through that in just a minute. But you have pools, you have buckets, right? These are the eligible costs that you can actually take if we identify these costs as being part of the research and development for the business, right? The number one thing, and you can see by the huge piece of this pie right here that is the focus, it's usually going to be wages, right? And so a lot of the wages are the big bucket pool that's taken here, because when you think about how the research and development credit is administered, it's mostly going to be time and employees' time in terms of figuring out how to do certain activities, processes, a whole bunch of other stuff, right? And then, of course, we have contractors. You only get a certain percentage of the contractors if you do it, and there's a lot of rules when it comes to what contractors are included and what isn't. There's also a lot of rules in terms of like what could be a qualified project based off of how the contract terms are adjusted. So in general, we do contract reviews. We take a look at who's who the costs are actually attributable to, especially under the rules of the law, and how court cases and et cetera have kind of worked themselves out. And then, of course, we have another bucket here, the supplies bucket. Usually it's relatively immaterial when we look at some of these other buckets right here. The big bucket is always this wage section. So what is what is research and development according to the IRS? Well, we have this easy kind of, I shouldn't say easy. Of course, there's always been there's been a lot of debate on what is what on this and why. I mean, there's a lot of court cases that kind of illuminate us in a lot of these different directions. But The first thing is it just needs to be a new and improved design, right? So that's the first part of the four-part test. And that means like a new and improved product, process, software, techniques, formulas, invention. Like it can be any of these different items, right? The one really key unique aspect here is that it has to be new to you. It doesn't necessarily be new and groundbreaking. I know we always think about guys with lab coats on when we think about the research and development credit, but it's a lot more nuanced than that. A lot of times it's dusty engineers that are out on the field doing calculations and iterations on different levels of calculations. The second aspect of it is that there has to be some uncertainty, right? And there's some uncertainty that we're trying to eliminate here. One of the things that I like to kind of talk about a little bit, at least high level, is, say soil. You want to figure out, hey, how thick is this soil? I'm an engineer. I'm trying to figure out how, and I'm not an engineer, right? I'm a CPA, so take everything that I'm saying from an engineering angle with a grain of salt. One of the unique benefits of corporate tax advisors is we actually employ engineers and they discuss these unique components with the engineers on the field and stuff. But let's say we've got like a soil, some kind of soil, and we don't know how well it's going to hold the foundation that we're putting in there. So we have to run an analysis on the soil, and we have to do a lot more nuanced kind of understanding. Maybe it's soil that we're not familiar with and stuff like that. So we have something that's a new basically kind of a new design, or and then there's an uncertainty component to what's in that soil. So we have to go out and we have to experiment. We have to go through a process of experimentation where we're retrieving these things, we're looking at them, and we do it a couple times in order to make sure that it actually works. So that is part of the nuance of the research and development credit in general. The other thing is it has to be technological in nature. And that doesn't mean necessarily like, lab coats and stuff like that, but it means the application of some of the physical sciences that we know, like principles of science and engineering, specifically like physics, chemistry, biology, computer sciences. A lot of these different things will factor into play, but it has to meet essentially these four factors, right? The new and improved design, eliminate uncertainty, technological in nature. And then we also have to show that we're applying a process of experimentation. We're trying it out. We're making sure, does it work? Does it not? Do we have multiple saved iterations of, say, especially nowadays when you can go in and save designs and things like that. You have to, I mean, you kind of have to be able to show that, hey, we're structuring it through, multiple experiments just to make sure that we actually hit all this stuff when the project is done. So it's a incredibly kind of interesting credit, and it's heavily underutilized, I would say. So one cool thing here is the requirement to disclose contemporaneous record keeping timesheets was eliminated in December of 2003, along with the discovery test, right? So there's some things out there that, people like, we don't necessarily time our work and stuff like that, that allows you to kind of go back and actually take some of these things, especially if you don't think you necessarily have the best records at the time. This basically kind of helps a lot of taxpayers still claim the credit and then get on the right course, so that way we've got proper justification for any kind of credits, any kind of items that are in there. And there's significant case law supporting a taxpayer's ability to estimate. Relatively estimate. And I would say estimate is a strong word, but for the most part, what you have is application of experience. Like with our engineers, it's an application of experience in terms of approximations of time that might be spent on a particular project in terms of ascertaining if they're meeting all four parts of those tests, right? So contractor fees, and I'll kind of gloss over this a little bit, but you know, it's basically who is taking the financial risk on as you're going through this process. The person who takes the financial risk is the person that's performing the research and development, right? And so, there's a lot of nuance in how how contracts are written. And so really what you want to find is very, very succinct, kind of like a lot of things that will indicate that you are the responsible party. right? And so sometimes when we intake a new taxpayer, we might have to look at their contracts and we might have to say, hey, you might have to restate some of these items, just, I mean, especially, going forward. So that way you're able to take the full amount of the credit. And same thing, if you are working with your contractors, you need to make sure that you're retaining, if, as a taxpayer, you need to make sure that you're retaining the essentially the financial risk I mean the financial risk and all the costs that you're outlaying for that research and development. So there's a lot that goes into that. We can get a little bit more nuanced as we go along here, but I need to run through this a little faster. All right, so just to kind of give you guys a high level estimate, or like a mental calculation, if you will, of like the different types of W-2, like the different types of I mean, roughly how this is calculated, right? You can take your W-2 wage expense and you multiply it. And, in this case, we're talking 25% of W-2 wages. That's going to be mostly applicable to like things like engineering clients, architects, and there's a wide variety of percentages that could be possibly applied here, right? But you say 25% of a project was, essentially meets all the four criteria. And then we can do this essentially this calculation here where we're pulling out these qualified research expenses that we paid employees to perform these functions with. And then, I mean, this is kind of the back of the napkin math here, like 7.5% times that qualified research expenditure will kind of help you project what the annual net federal tax credit looks like. And then, of course, if you multiply that back a few years, that's going to kind of give you a lot of that in play. Now, one thing I did want to just show you guys was there's a lot of industries that most people don't know perform research and development types credits. The big industry where it's very easy to kind of see that R&D credits apply is in architecture and engineering, because they're constantly doing design iterations, they're constantly learning new and unique items and adding that to their knowledge base, right? And so when you look at it, they're going to have some of the highest qualifying factors, between like 5 to 30%. There's a bunch of other ones which we can put through, but it's surprising when you actually look at this, the amount of different industries that it applies to. Food and beverage, for instance. Actually, one of our founders, he likes to make claims like, most companies that are doing $10 million in revenue, it's almost physically impossible for them to not be performing some level of research and development. When you think about it, that seems to ring very, very true, because we're constantly trying to innovate and like beat our competitors. We're constantly trying to do some other things. So you'd be surprised at the level of which research and development actually exists for a lot of these different types of clients. Retail and distributions, logistics and warehousing. You know, um, I mean, you think about Amazon. You think about how Amazon is constantly reinvesting in their product and design and their ability to deliver. You'd be surprised at how a lot of these guys actually do qualify. Now, I would say the big three there. If we're just trying to say target specifically big three, architecture and engineering, and you'd probably say, software, and then you would also look at um, manufacturing, right? And all of the different types of levels of manufacturing that are out there. Those three things, and especially now that manufacturing has been opened up to a lot broader stuff, and I'll go over that too when we get down to the cost section. But because of how the OBBBA was written, you can see that they're really trying to bring back manufacturing to the United States, and they've incentivized that properly. So we're probably going to see, as CPA practitioners, we're probably going to see a lot more manufacturing, at least in the next few years with the tariffs and everything else that's going on, right? Um, one thing to note here before I get too far into it is that we like, there's software guys that are out there. A lot of the times they will be negative revenue, and you're like, well, they're not going to use the credit. Well, if they're within a 5-year time period and they meet some a lot of other parameters, they can take the tax credit against their FICA taxes. It's one of the cool things that you can do, and one thing to kind of understand that that is out there. So they might not necessarily show tax on their form, on their income tax form, but they probably will show tax, paying employees, right? And so it's good to just be able to offset that extra tax. So that is something that's out there and something to kind of keep in mind as we evaluate possible taxpayers. And with that, I will go ahead and trigger the next polling question. All right. Polls back and launch poll question number 2. All right, so I'll try to leave that up here until the next polling question. That way we've got proper time to answer. All right. So this is this next section here is just about the differentiating factors between Section 41 and Section 174, right? They're two distinct sections of the code. Like I mentioned before, nothing really changed since 1981, and since we extended that same R&D credit that entirety of the time. Nothing really changed with Section 41. But what was the drama around R&D credit? Well, it was Section 174. And so it's just important to kind of note that these two things were very independent, and that Section 41 has always been consistent. There were no changes to how Section 41 really operates, except for, I will say there was one case here in the OBBA where they allowed the Section 280C application to prior years that would be somewhat within the purview of Section 41. But Section 41, that is the heartbeat of the research and development credit. Like we talked about the 4-part test, all that other fun stuff, right? This is basically that's the heartbeat of the research and development credit. And as I've just mentioned before, the criteria of qualifying factors, it has not changed, not at all, right? And the purpose of that code in general was to stimulate U.S. innovation, which is what made it so funny when Section 174 came out, and it seemed like it was the purpose was to kind of stifle it a little bit. So it was interesting to kind of see that in nature. Section 174 itself, it was actually built into the tax code in the 1950s, and the whole point behind putting that in there was to allow companies that were in startup phase to show higher income on their income tax returns so they could get better funding and stuff like that. So, I mean, it's kind of funny that it was built in there, but you could always elect out, right? And what they did in that very specific thing in the Tax Cuts and Jobs Act in 2016, I think that was 2016, right? Or maybe it was 2018. But in any case, in the Tax Cuts and Jobs Act itself, what they did was they just removed a line that said you can elect to expense this. And when they removed that line that said that you can elect to expense it, they made it required, right? And that requirement was baked in to get it past the budget, right? But it was baked in like 3 or 4 years down the line, with the whole understanding that at some point Congress is going to go in and say this would be completely stupid and unfair. We shouldn't perpetuate this. But what happened was, we got a congressional deadlock. We had a lot of issues in terms of getting this, in front of their faces, and it took a long time for them to actually do anything about it. But the cool part is that, they did something about it. They did it technically kind of 3 years late here, so it's hard for a lot of people to go back there and correct a lot of these things. But they did actually just essentially kind of give you a fix in whole, right? And so, like I said, they were trying really hard to make sure that they addressed this, but before we knew it, it was 2022. Nothing had changed, and all of a sudden, people were forced into this capitalization requirement. One of the issues with that is that you were forced to take Section 174, regardless of you taking Section 41 or not, right? So as long as you had research and development expenses of any shape and form, you had to follow Section 174, right? And the way that I always look at Section 174, I mean, especially when I was in corporate tax, working with BDO, BKD back in the day, there was this UNICAP provision, which was kind of eliminated with the Tax Cuts and Jobs Act. I mean, some of the older folks there will remember what I'm talking about, but you had to capitalize overhead, right? If you had inventory of any nature, that was basically force you to do that until we had some of these definitions on what is a small business taxpayer, who doesn't have to do this forced capitalization on your inventory, right? And so the way that I look at it is Section 74, 174 was basically unicap for research and development expenditures. And it was incredibly damaging in a lot of ways, right? Because whether or not, like I said, whether or not we pursued that credit under 41, you were required to capitalize costs. And it would have been really difficult for, a lot of small business taxpayers to understand what that exactly was. And then the way that it worked, there was a forced capitalization that was above and beyond what was in the qualified research expenditures, and you had your administrative overhead costs that needed to be added on top of it. So it was extremely damaging in terms of the amount that, especially that first year in 2022, because you think it's a timing difference, right? We get to amortize over 5 years. So it's just a timing difference, right? But the problem is it was a timing difference where all of the damage happened up front, right? And so you had taxpayers that had to pay a huge amount because they didn't have the benefit of that timing difference over a longer time period. And so they ended up having to pay a lot more in taxes than they really, really wanted to pay. And so what we saw in practice was people were pulling back their expenses on research and development. And that, I mean, in all honesty, it's kind of damaging to the United States and stifles innovation. And we're lucky that we were able to finally address this and go back and fix it. And the cool part is, like I said, you can go back and fix it if it was done in the past, because what they did was they basically made it as like, I shouldn't say as if it almost never existed, but very close to exactly that kind of mentality as far as how, I mean, as how it worked. The problem is you have to navigate the complexity of the law in terms of method changes, accounting changes, stuff like that. So they made it way more complicated for no reason. It turns out, as we go back and look at it, and we've talked to taxpayers that didn't take any action whatsoever during that time period, and they're completely in the clear. They don't even have to file a lot of these extra elections or anything like that to get to actually, it's one of those cases where you're actually almost penalized for following the directives of the rules at the time, right? So, in any case, um, you know, this a lot of the taxpayers we saw, they were doing different things. They were making decisions. A lot of them were fine, by the seat of their pants on this, because it was quite clear that it was not the real intention to actually make this thing happen, and nobody quite knew exactly how to handle something like that, and especially if it had a huge bloody nose attached to it with a huge tax bill due. So we had taxpayers and practitioners that might have done stuff where they were like, we're going to comply fully with Section 174. And when you looked at it, the only thing that made sense was you go ahead, you comply with Section 174, and you take 41 credit the entire time, so that way you didn't lose any of the credit that was out there. And over time, with the timing difference factored in, you eventually kind of you accepted it, right? Or you tried to get a little bit more creative, right? And so you can comply, but maybe you wanted to start pulling back research costs so that you didn't have as much of a tax damage next year. So as I said, it indirectly led to the stifling of innovation in this country. So we had a lot of folks that were doing that, like pulling back on their research expenditures, right? And then lobbying legislators to try to fix the situation because it was completely and patently unfair. Then we also had taxpayers and practitioners that were just like, well, I mean, it's so unfair. What do we do here? Like, and so they could have taken a lot of stances, right? They took a stance that Section 174 would eventually be rectified and continue to pursue credits under 41 as normal. That would be the previous scenario where we're talking about fully complied, right? You can take a stance that if you didn't pursue Section 41, there was no cost to capitalize, which wasn't really true. And especially for the large business taxpayers, that's still not true. They still have to go back there and make sure that they have their 174 costs in place, right? Because they could potentially come under an audit for those particular ones. Now, it's a much more limited group of taxpayers that applies to. But I mean, the cool part is they basically made it clear, gave you a get out of jail kind of free card, if you will, for the small business taxpayers. We'll get into, what is a small business taxpayer, et cetera, in a minute. And then we also had guys that, completely pulled back on R&D or attempted to redefine what R&D actually meant. So were taking a little bit more aggressive stances on it not being R&D credit. It was a wild rootin' tootin' west, wild west time, if you will. So there was a whole bunch of fix attempts too. I mean, it was just an absolute disaster, right? We had HR 2673, we had S 8866. You can see they were like working it from both ends. They're working it from the congressional, the normal House end, and then they were working it from the Senate end. I mean, look, one, two, three House end bills, two Senate bills. Both, I mean, almost all of these were trying to figure out exactly what to do. So we saw a lot of this stuff come through, and we were just, we would try to like help, in any way possible in order for them to understand that it was just completely detrimental to the United States' interests, right? But then, ta-da, we got relief, right? So let me go ahead and start the next poll. And that would be poll question number 3. And now we get into the One Big Beautiful Bill Act, and all of the goodies that were in store for us there when they actually decided to fix this. So the big thing was is that they proposed retroactive treatment, right? And they proposed that, specifically for small business taxpayers, which they defined as under $31 million of average gross receipts over the last 3 years. So if you had a taxpayer, and we'll get into this in more detail, but basically 22, 23, 24, if you stack all those gross receipts up together, divide it by 3, you're underneath the $31 million range, you're basically considered a small taxpayer and you have retroactive treatment available to you, right? So when you have retroactive treatment, you really have 3 methodologies in which you can pursue, right? You can pursue amending your tax returns to, get rid of the Section 174. You have the ability to expense all of it in 2025, or anything that you had capitalized over that entire time period in 2025, or you can split it over 25 and 26, right? And there's some reasons why you might want to do that when you think about NOL and the 20% unusability of a particular year. You might want to, you might want to plan around that, right? In terms of like how much of this is going to hit all at once. A lot of guys would have huge $1 million expenses that would be going out. And so really when they did this originally, they basically, instead of doing a 3115 when you were changing into the Section 174, you would attach election to say, hey, we're going to follow the Section 174 costs. So you would just attach like a little election at the end of it. You didn't have to file a 3115 or a formal method change. And that was one of the guidance that came out in one of the Rev Procs previous to that. And then in the recent Rev Proc, they basically made the same thing. For 3115s are abnormally burdensome. You do have to do it when you do a 481A adjustment, though. So if you're doing it, you're expensing in 25, or you're expensing 25, 26, you're going to have to do a 3115 along with a 481A adjustment, right? But they're all automatic method changes. So in terms of a burden, a little less so than you would expect, right? But they also made the Rev Proc itself a little bit difficult to navigate, which we'll go into heavy detail here in just a moment. Apologize. Sure that that doesn't happen again, folks. All right. So like I said, they were proposing a method change, right? And it's automatic change in the method filings, right? And they recently just issued that 2025-38 Rev Proc. The fun part about that one was that they issued it right before the filing deadline for partnerships and S corps, maybe about a couple weeks before, and then they granted automatic extensions. Even if you had filed previously in the year, they basically gave you the ability to file a superseding return, especially if you were under the BBA regime, right? That was really the target in which they left that open for you to file those kind of things with. So then that gives us the next question, which is, what should we do now as practitioners? And I will go ahead and give you guys the next polling question. All right. And like that, like I said, there was a bunch of different options that were out there for us, and it really depended on what we did or what we didn't do. Uh, and you know, I will say that this little handout that I have here, let me just go ahead. I'm gonna go ahead and just put this into the chat system here. So that way, if you guys would like to pull it, there's just a little handout here that kind of goes through some of the planning items around Section 174. If you are in Section 174, and depending on what stances you may have taken or whatever stance a newly acquired taxpayer has taken, you should be able to go ahead and pull this and kind of get at least a good idea of things. Now, this one was what hasn't been updated for the RevProc that came out, which I'll go into a lot more detail here. But I mean, essentially, it will be it will we have another article for that as well. I'll just give you guys both of these really quick on how to handle the RevProc items. If you're trying to go back here and actually address this with your folks, I'll just go ahead and pull this back up. But there was a bunch of different, there's different categories, right? Because we have a small business taxpayer and we have a what's considered a large business taxpayer, right? And so, if you, and like I said before, small business taxpayer, take 22, 23, 24 gross receipts, divide them by three, right? And if it's under $31 million, that's a small business taxpayer, right? I would say there is an exception to that because you also can't be oh man, the words escape me. It's on another slide here, but you can't be a loss or a loss passive loss company. I don't know why my brain's not working on that one. But the essential gist of it is that if your business is a small business qualified, right? Like you have a couple of different items, right? And you like let's say you took full advantage of 41. Well, look at your those previous tax years and determine the most appropriate years to file a change in method. Either you go back and you amend those tax years, right? Or you expense it in 25 and 26. And like I said, one of the considering factors that you probably should put in to play there is am I going to put the taxpayer in an NOL position so that they might not be able to utilize the full amount of the deduction in whatever period that is. I would say that I've done a bunch of these analyses. The majority of taxpayers, it's best if they qualify as small business taxpayers to go back and do the amended returns for those specific years. But there's all kinds of reasons why that might not be the best thing. There's been specific instances when you think about how the BBA is structured in filing AARs for a partnership. If you say you didn't elect out of the BBA, well, yeah, I mean, you basically have to file amended tax returns before the end of this year on the entity end of it in order for it to be applicable in 2025 or against your 2025 individual returns. And then you also run the risk too there. The way that the BBA works is, I mean, you basically recalculate tax for each one of those years and then you put it all into 25. But if you have tax offsets that don't match your tax liability in that particular year, they can just fall off completely. Right. And so, I anticipate that the majority of people who fall underneath the audit regime are going to go ahead and just do the full expensing with 481A. Right. And the majority of those folks are going to be that's going to be their best benefit as they go through that process, right? And so, if you had Section 174 costs and you are a partnership, most likely 25 or choosing 25/26 is going to be your best benefit. But for most S corporations, if you had elected out of the BBA and I mean, and you have the opportunity available to you, and there's like a fewer amount of shareholders, that's a good way to do it is to go back and take care of those things for those past years, right? Of course, C corporations, I mean, it depends, right? Depends on what years are coming back and what aren't. But it's the same tax rate applicable to all of them versus the shareholders, and that's the reason why they gave the shareholders and for mostly S corps, right? Shareholders, partners, the ability to go back and amend those tax returns. So really important to kind of consider a lot of different alternatives as you're looking through it. Now, if they're not small business qualified, you're going to have a massive deduction most likely in 2025. And so you need to plan, okay, well, does it make sense to dump it all into 2025, or does it make sense to space it out given NOL limitations, right? And we know those things are always a hassle. We don't want to necessarily carry it forward to a future period. You want to maximize your cash, right? The other thing too, and I mean, this came up a lot this year, was, especially if we had acquired taxpayers that were operating with other R&D service providers, you would see like that there would be like a market drop off of claims for research and development credits. And now that you kind of have a get out of jail free card, if you went back and looked at it and you actually found, and you were a little bit more critical about what is and what isn't research and development credits, you probably would find a bunch of, bunch of credit that's in deductions that are applicable to it. So you always want to make sure, like I said, all businesses have a duty to make profit. So they're going to go back and, you want to pick that profit up as much as you can, right? Now, if for some reason, we delayed or disregarded implementation of Section 174 and your small business qualified, like this section right here hasn't been updated, but when we looked at it, there's no change in method, right? Because you technically didn't change a method. Like, and so they're really, basically, you don't have to file any elections or anything like that from that perspective. But one of the things that the OBBA opened the door on was additional Section 280C deductions that are allowed. That treatment for that. And the reason why, so you have to pay tax. Just a real quick description of Section 280C. You have to pay tax essentially on the credit, right? Because that's cash value that you're essentially handed over by the government. So you either pay tax through adjusting your wages, like adding back the amount of wages that were used for the credit. Adding back the credit itself, right, and pushing that through to all the shareholders or all the partners. If you're a C corp, it's 21% regardless of how you do this. But what they offer you, if you file timely on, generally speaking, with a research and development credit, you're allowed to get a tax affected amount at 21% versus an individual rate at like 35, 35, 30, 37, and so essentially you get an extra tax advantage by being able to take the 280C and tax affecting it directly on the form. The other cool thing that it does, especially when you're doing these adjustments, if you're doing amended adjustments, is that you don't have any kind of tax add backs or any kind of tax liability that could get generated in any of those years because you've already taken into account the tax effect with that 280C election. So and if your taxpayer is not small business qualified and they didn't do it, basically they need to go back there and make sure that they're capitalizing, right? It is possible that could come under audit. And we're talking larger companies, like, if you're over $31 million in gross receipts over that entire time period, you definitely have opened the door on some forced capitalization. Of course, you get it right back in 25, but sometimes there's material differences between the 2 years. So I would hesitate to say that the IRS would really kind of push that super duper hard unless you were like SEC level and you just completely disobeyed all directives with it. But it's something out there to be aware of. If we didn't do it, you might want to go back and adjust those because you were forced to do it. You go, what's the net net? If you expense it all in 25, it really depends on the amount of taxes that are generated in each one of those particular years. So the one thing that you might want to look at, especially if you haven't done that, is, well, they probably left money on the table because they were afraid of Section 174 for whatever reason. And now they get to go back and take that credit. So, and not worry about it, especially if you're under that $31 million threshold, you can go back and take that credit and you get to take advantage of the 280C. So they're trying to make it, especially for the small business taxpayers, as if this never happened. So they basically open the door there. So especially if you're looking at taxpayers that may have came into your office or haven't been, part of your client list for a little while, or maybe one of the reasons why they left is because their CPA didn't talk to them about Section 174 and didn't say, hey, this is coming, this is coming the direction, in your direction. These are the ways to handle it, kind of stuff like that. Maybe that's why they left and came to you, right? It's very possible that we have items there that we'd like to pick up. And I think that at the end of the day, that's the cool part about this is it basically gives us carte blanche to look back, try to find that stuff, make sure that we're accessing it, getting our full amount of the credit. So as I said, 2025 is the criteria year for eligibility. And I think one of the original readings that I had on that was it was going to be like, part of 25. There we go. Tax shelter was the word that I was looking for because the way that they define tax shelter is a little odd here too, right? And so I'll go over what that is in a second. I mean, it's defined as a partnership in which 35% of losses are allocated to limited partners. So if you're in a loss year for some reason in 2025 and you've got a partnership, you want to double check that to see if you were excluded or not. Now, the criteria factor in that is only 2025. So it's really, we look at 2025, did we have a loss year? If you didn't have a loss year, then you don't really have to worry about it being considered a tax shelter, right? So, but if you did have a loss year and you've got some limited partners, you got some partners that aren't really active, that you do have to be concerned about this. And part of what you are doing when you address these things in the tax return is making an election, right? A testament saying, I'm not a tax shelter. I meet the 448C criteria, right? You're holding up your hand to the Bible of the IRC code and you're saying, I swear, right? That's the case. Okay. Um, the 2025, and if you look up the actual factors and because it's kind of hard to see this because it's inflation adjusted every single year, but it's $31 million for this year. So you don't have to do the extra legwork. We've already done it for you. And the manner and method of making the election, right? 2024 returns, if you did in 2024 just fully expense it, well, that's considered a deemed election here, which also means that you're electing to go back and amend those tax returns for those specific tax years, right? You basically said, hey, I'm choosing the amend method. I can't just expense whatever's left over in 25, right? You have to do one of those three methodologies. Either, like I said, go back and amend 2025 or 2025/2026, right? And at the time, especially there towards in September, they basically gave you an automatic ability to file a superseding return, and that was especially applicable for BVAs because, I mean, an AAR is a huge hassle, right? It's a huge hassle. Actually, most softwares don't even really support it unless you got Thomson Reuters or CCH. It's not a great way to handle a lot of those things. So, like I said, my anticipation is the majority of people are just going to kind of have to be forced into taking it. They want to take it in 25, forced into taking it with a 481A adjustment on a 3115. But this is the cool one, man. I say it's so cool because we're doing back studies right now, and when you do back studies and you have the 280C election at your disposal, it's a huge tax differential, right? I mean, we're really you're saving like what I mean. If we have like a top rate of 37%, you're saving like 16% of taxes, right? On taxes by running through a 280C adjustment. So that's really cool aspect of going back and doing that. Now, if you are addressing this, if you expensed it immediately on 24, especially like right away without having to file an amended tax return, you didn't have to attach this election in it to let people know that this is what we're doing. But if you didn't, and we were looking at going back and doing that for 22, 23, 24, you want to make sure that you attach this election to it. And like I said, a lot of this is just attestation that that this taxpayer is not like, see, you see how it's written too, is I'm not a taxpayer, I'm not a tax shelter basically for like in 2025, right? And that I meet the criteria of it being $31 million or less, right? For the 3-year gross receipts test. That's what part 2 of this election says. I meet that criteria and I'm allowed to do this and go back and amend the tax return. And that you're making the election to deduct it, or you can make the election to capitalize it too. I mean, it's like you can do different things with it, right? So like it says here that you're essentially if you did it with expensing in 174, you got to go back and file those other ones there because you're essentially making this attestation too when you did it. You're having a deemed election, right? So you're meeting all of these criteria and factors, including the fact that you are promising that I'm going to go back and amend the 22 and 23, right? So important to note that. Yes. So that's like I was saying before, the tax shelter thing is kind of an issue. You just need to make sure that when you're doing it, I am not a I'm not a tax shelter. That is one place and area where you could have a slip up, right? You just got to look at, hey, is 25 showing up as a loss? If it's showing up as a loss, I need to analyze that a little. And I've got a partnership. I need to analyze that a little closer before I start looking at the BBA. But like I said, most people are probably not going to go back and file the BBA if you're a partnership because of how the windows work on BBAs is you kind of have to have all those amended tax returns adjusted and pushed through before the end of the year. And there's the possibility that some of your extra loss that you're trying to use against that is going to fall off. And there's no recourse for taxpayers. There's no way to carry an adjustment, an income adjustment from a BBA adjustment applicable to a specific tax year forward into the next year. You'd think, I mean, that seems insane to me, right? Because you're able to take personal NOLs, able to take a lot of other things forward, but that is one thing that just it can just fall off and you get nothing out of it. So the best thing to do for the majority of people is going to go for 2025 and hit it from there, right? Um, the manner and method of making an election here, and this is for if you want to expense it, right? There's a 481A adjustment with the Form 3115. The DCN is 273, right? And I think the 273 is utilized also here for 25 and 26. I'll be working on, like a template version of the 3115 and some other stuff to hopefully have available for our taxpayers. So that way they can take a look at it and adjust it, especially our taxpayer preparers that we work with. So that way they can take a look at it, adjust it, add it to the tax return for 25. All right. We are so close here with the first hour. And I'm going to go ahead and launch poll question number 5. And, we're about to exit the research and development end of things. We'll go back to it a little bit later here with questions and answers. But if there is any questions or answers, please let us know in the chat. And I'm sorry, any questions. If you have any questions, please let us know in the chat. And that way I can try to, address them as we go. Now we get to talk about, how cost segregation and the O triple BA changes affected cost segregation. And, I'm going to give you guys like a lot more of a high level overview of what cost segregation is and kind of how we use that to help taxpayers get out of, maybe say sticky situations or extra liability that they might have in a particular tax year and some of the cool things that surround it because cost segregation is an excellent planning tool if you haven't utilized it before because it applies to a lot of businesses and it is one of those ones that is definitely heavily underutilized and people don't even consider it sometimes for folks that are in like self-rental situations and stuff like that. So, it's not necessarily just your real estate developers and it's not just necessarily the people that are managing rentals and a lot of different aspects when it comes to that. You're going to get a lot of different things when you actually apply this stuff. And I mean, there is a unique advantages here in terms of like when you can make a DCN or you can make a change in method and take full advantage of it and offset specific tax items that come up. So it's really cool. I mean, in terms of a tax planning kind of item. So here are the big three things. There's a little bit more there in how they adjusted Section 173, made the amounts a little higher, so that way you didn't have to do you didn't have to comply with specific aspects of Section 173 you might have had to before or even I think your add back got a little bit less. But in any case, these are the three big things that kind of help, this next year. We've got bonus depreciation. It's back and at 100% made permanent. Like what a cool thing that is allowed for. And you'd think, well, I mean, anything that I buy, I should be able to expense right away, but not real estate. And the reason why, you'd think not real estate is because, hey, a lot of that's debt finance, right? It doesn't mirror cash coming out. But what the bonus depreciation does is it allows us to take, if we've got basis in it, we're going to have to pay that debt off at a future point. It allows you to basically take it all at once. You get to take that expense, and it's extremely fruitful when we think about especially how cost segregations work. And it's pretty interesting. Here's one thing, and I know this one's often glossed over, but the property has to be placed in service after January 19th, 2025. It's just a weird thing that was built in the bill here. So there's a weird period there where, if you place it into service between 1/1 and 1/19, you're going to have like a 40%, you're going to have a 40% bonus depreciation instead of the whole 100%. So it's important when you think about when things are placed in service, when we're talking to our clients about what's placed in service and when it's placed. Sorry, guys. I was trying to just move something over the screen here. When it's placed in service, and when you're talking to clients about when it's placed in service, yeah, I mean, of course, you have to think it depends on when we have like there's a little bit more wiggle room around that kind of stuff. I mean, just make sure that you're understanding that when you're talking to your clients that, there's just a weird window here that could be damaging if we place it into service at a particular point in time, right? And so just important to have that conversation, right? And then there's a cool thing, like I said, hey, like this is if you ended up with a huge expense of Section 174 in 2025 and you're going to go NOL on it, maybe you don't want to take all your bonus then. Because you don't want to get into super heavy NOL territory. Maybe you want to push it over into some of the other years that are coming up. And so you might want to take advantage of this, but you basically have the ability to say, I don't want to take we all know that we have the ability to completely elect out of bonus depreciation. We can just go straight makers for that year in whatever category that we want, right? So from a planning perspective, it makes 168K really fruitful. That's kind of where you spend a lot more time, from a property planning perspective, because you can kind of pick and choose a little bit to get the tax number to the right number depending on what you actually bought over the year, right? So you can that's the only place where we actually have a carte blanche to make elections, move stuff around, and make it work for the taxpayer to a way that's probably in their best benefit. That's one of the reasons why cost segregation itself is so fruitful for taxpayers, is because it helps you move the timing differences into the arenas where you need it the most. So in this case, you have the ability to either take the 100% bonus depreciation, you can elect to take 40% bonus depreciation, or you can elect out of bonus depreciation, right? So you have those three possibilities now at your fingertips, and you're allowed to kind of deal with any of those on any of your clients, and depending on anything that they bought, right? So that's a really cool, unique aspect of it. And I usually, especially when I was in practice, my preference is always for bonus depreciation because I can go negative, right? And I can offset other active income or other income on their books, depending on the classification of what I'm taking the deduction on, right? But I would always just go, well, I'd rather just go negative. But now we still have that NOL, that pesky NOL issue where we've got that 20%, that 20% or 80% limitation there on offsetting, right? And so it's just important to factor that in when we're doing planning, right? And how that's going to work. Well, Section 179 is still out there. You'd always go into those things where you're like, well, what is the business income limitation that turns into like a weird circular kind of route where you're just like, okay, maybe if I go down a little bit here and push that through, my business income limitation hits X. If anybody's ever had to do that, you narrow it down to exactly the right amount on the business income limitation line, that can be a difficult undertaking, right? But they increase the limit, right, all the way up to 2,500, and they increase the threshold. So it's just another tool in your toolbox in terms of expensing, which can help you from a planning perspective really get to that maximum, the maximum amounts that you're kind of trying to look at and target, right? So, Section 168N, this is one of the new things that came out here, and that's going to be the qualified production property. Like what I was saying earlier, that the majority of what I see here from a business perspective, from the OBBA, it was all driven to drive, I mean, it was all pushed to drive domestic productivity, right? In combination with tariffs and things like that. So the whole point of a lot of this legislation was to try to bring things back home and I guess it's the whole make America first kind of thing. Like push us back into a sphere where we're actually manufacturing products again, and we're bringing hopefully we're bringing jobs back home, right? Maybe robot jobs, but hopefully we're bringing jobs back home, and especially when we talk about like from a national risk perspective, having a lot of stuff overseas is probably not a good look for us. I think in general, you want to make sure that you have a good heavy manufacturing base here in the United States. I think that was one of the reasons why, if you look historically, like WW2, why we were able to be a little bit more, we were able to transition our factories, we were able to do a lot of different things that other countries didn't have that quick kind of flip of the wrist with to get into the ability to defend itself, right? So there's always a good national interest to have say, yeah, I think there was a bunch of times where they talk about, bailouts for, car companies and stuff like that. It made more sense to keep a lot of that stuff here stateside because you wanted to be able to transition from a national defense perspective if forced to, right? So there's a lot of reasons why you might want to do it. There's some reasons why you don't, right? More expensive. That's one of the bigger reasons, right? But in any case, we got Section 168N, qualified production property, and so what it is it's activities that are in very specific sections, right? A qualified production activity is manufacturing, processing, refining, or extraction of tangible goods, right? Including space integral to operating production equipment. So if you've got a taxpayer that is looking to place construction, I mean, looking to start construction or they started construction in 2025. The really cool thing about this is it takes property that would have been 39 years over a very long time of expensing, right? Just a little drip drop, and it allows them to take it all at once. Right. That's crazy. I've never seen real property be able to give granted that same kind of level of deduction ability. Right. So that's a very important one, especially when you're looking at new manufacturers, new people that are out there trying to get like do that extra planning. This is a very crucial one that's probably going to be overlooked by a lot of folks, but I mean it's out here. It allows them to take it all. And so I think the one thing it doesn't include is office admin, sales, R&D, engineering, software, lodging, parking, stuff like that. And part of what we do in cost segregation is kind of help break out a lot of those things. So I can imagine that we will have some extra applicability for some of those specific types of items, depending on if there's manufacturing, if there's there basically will be a breakout of the back office, right? And then the front office, in terms of what you can take, what you can't take. So there will have to be some amount of segregation that needs to go on. Maybe that's square footage, kind of things like that, as you're looking at all that stuff. So it's yet another reason why a cost segregation study would be important as we're applying that to, new manufacturing, new things coming online beginning in 2025 or later, right? Oh, one thing to note, if they change the use of whatever facility it is that they're doing, if they go out off of production for whatever reason, you may be subject to reclamation at that point. So it is important to know that as well, right? So, but I mean, you're subject to all depreciation recapture at some point, you just don't get to take all that deduction all at once kind of thing. Okay, so those are the OBBA updates that I think are most crucial to cost segregation when we're looking at this from an overall perspective. As I mentioned before, the way that I like to break this out is I like to flag it in my head and then, you know, work with people that kind of know a little bit more if I don't know enough about it to or actually be able to form the studies. Like for us, we have, like I said, we have engineers. Thank God, we're not trying to take the assumption that we can do a lot of that stuff without that level of justification, right? You think about like research and development. I mean, it's crucial that you have the team of experts really kind of looking at that, and especially with all the case law that goes through it. team of experts that understand and can communicate with the taxpayer, especially if they're engineers, especially if they're in architecture and stuff like that, and to figure out exactly what that percentage is for a particular project. You want to make sure that that's very clear, right? It's a little harder to do, but um, and and when you look at how the IRS defines a cost segregation study, like what they're looking for when you open up the audit technique guide, they're looking for engineers, like they're looking for people who have sufficient enough experience in which they can make an application of their experience into how the cost segregation is performed and all that. But these are the things that I know that taxpayers are going to have questions on, and you're going to have a question on, at least with the final question here. But the first two is, I know that this is how you're going to have to tell your clients, like, this is what a cost segregation study does. This is how it saves you money. Talking to them about what a timing difference is, right? But how we're moving it and accelerating it all into a particular period in order to take advantage of it. There's a lot of things that make it a little bit more of a nuanced conversation, right? So the way that I've broken this out is I have these two questions. These are kind of like the questions that I would have, because I need to know this stuff to be able to talk to my taxpayer, right? How much does cost segregation save the taxpayer? Is it worth the taxpayer's time, right? How does cost segregation work? I think in general, like what does it look like when a study is actually performed on one of my properties? And then how do I and from a practitioner end, the last part is, how do I identify who it is that can really take advantage of this, right? And when can they take advantage of it? These are all crucial things that me as a CPA preparer, consultant, really wants to know, right? So just high level, we got to start with the 10,000-foot view first. But cost segregation basically is what it does is, we have these long-term property reclamation periods, right? Like if we have a residential home that we placed into service, we're doing rent on it. When we place it into service, a lot of times we'll take out a little bit there for land, but then most of the time, the bulk of it ends up going into 27 and a half year lifetimes, right? So 27 and a half years is a really long time. I don't think I've been a CPA for that long. I haven't been a CPA for that long, but it's a very, very long time in order to reclaim the cost that you've outlaid already for a specific item. Of course, we've got mortgage stuff and a lot of that stuff. So it's not necessarily the mirroring principle, but it's a long time to be able to not take those specific deductions. And especially if you're looking at commercial property, 39 years, that is a long time to get that back. I know I've seen plenty of them where I was still depreciating ones that were placed into service a bajillion years ago, and going through that 39-year property window. What it does is what cost segregation does is it identifies the pieces of property which we can consider tangible in nature, right? Enough to give them a different classification. Instead of a 27 and a half year life, we can give them a 5 and a 15-year life, right? Instead of a 39-year life, we can give it a 5 and a 15-year life. So we're able to, number one, accelerate it so it's a lot shorter time period. But number two, we're able to apply bonus depreciation provisions on those particular classifications of property, right? So what it can do is essentially take that 27 and a half year and move it all up front and take it at a time when it's more crucial for your taxpayer. That's one of the coolest things that's out there from a tax deduction perspective. We're able to kind of pick and choose, and the law gives you the ability to kind of pick and choose some of this stuff so that you can properly take advantage of it at the times when it's necessary to do so. When we're in a high tax year, when the taxpayer is coming to you, like, a lot of times you'd see that, like, oh, it's like 315. You talk to the taxpayer and you're like, hey, it's going to be $40,000 this year. You got that much, right? And they're like, no, I didn't know it was going to be 40,000. Well, you made a lot of money last year. What happened to it all? What put it all back in the business? That happens so many times, and it's because we get late guys coming in. Maybe we didn't get an opportunity to get a good full planning in. Their accounting's a mess. Like, unless you guys are doing their accounting, I'm sure it's perfect, right? But like, there's a lot of reasons why we just go, man, I wish I had a bunch of deductions available, and this one actually allows you to do that, which is really, really cool. And it allows you to do a lot of really cool planning things, right? And it does represent like a timing difference, but you can stack it, right? You can stack it on a 1031 exchange. You don't necessarily have to always pay the piper when it comes to real estate. That's one of the cool, unique aspects of real estate is being able to avoid a lot of taxation because of how the favorable laws are here in the United States. Here's a good rule of thumb, and the rule of thumb that I kind of look at. You can basically estimate the majority of these types of studies and how it's going to help your client by taking the property, going, well, I could probably save about 5 to 10%, and that would be your difference in cash flow. So you're looking at a guy with like 100,000. This is just there's no house in the world anymore that really costs this. You got a guy with a $100,000 rental house. Well, I know that's probably worth about $10,000 of cash flow deductions or reduction in liability, right? Between $5 to $10,000 in reduction of liability. So maybe I got a guy who's in a bind, like, and he owns a rental house. Well, can we take it against that? It does depend on the passive stuff. It depends on a lot of things, right? A lot of criteria, but it is a cool little card that we can use and we can find those specific times, and it's completely allowable by law, right? That's what we can do as planners, as consultants. So, like, it's where we give them that extra level of value. So, like I said, I think it's dependent upon usability and taxpayer classifications. It's always those passive rules, pesky passive rules. That was a tongue twister, but there's always those pesky passive rules that we have to keep working through. And the cool part is too is you could have purchased it 6, 7, 8 years ago. There's no statute of limitations on this one because what we have is we have a change in method that's applied here, not a statute where we have to go back and amend those original tax returns. So you can have something that was on the books that the guy bought like 6 or 7 years ago and just go ahead and take that this year when the pain's hitting, which is really cool to be able to do that, right? So when we talk about like how much can a taxpayer really save when we look at cost segregation, there's the like we'll just go with a little high level example here. Let's just say a guy buys buys or builds or buys a recently constructed property to rent, a little single family home or something like that for $500,000, depending on where you are. That could be a giant home, that could be a small home. Where I live, it'd be a giant home at $500,000, but um, if you're in California, probably not so much, or even some of the other places. So prior to cost segregation, 27.5 year life is how we would put that into play normally, right? And you always have to make an allocation for land, right? That's part of what we do. And then land, of course, is not depletable or depreciable in any stretch. So you mark off a portion of that. I think a lot of people use the rule of thumb 20%. But you get to take $400,000, deduct that over 27.5 years. Let's just say it's like towards the first part of the year. You got a mid-month convention, so that's why this number here is a little bit less. But over those years, over those 5 years, you had a total depreciation deduction available to you of $72,121. So what cost segregation does is it says, well, you know, of that $400,000, we have identified that $36,861, and this is off of real percentages, off of real things that we've done in the past, right? Percentages. Um, we've got $36,861 of 5 year property. We've got $76,000 of 15 year property, both of which are eligible for bonus treatment, right? And when we have bonus treatment that is giving us 100% and we are able to access that in a current time period, how cool, right? I mean, especially now, I know it says likely tax legislation. The slide might have been written a little bit before the OBBA passed, right? But we also have the ability. The reason why I left it in is because we still have the ability to use 40% if we want to, right? So it just kind of puts that into perspective here. But I mean, you can see with the bonus depreciation, us pushing it in there, we've already beat the 5 years in a single year. We've beaten the 5 years of deductions all the way up front, right? That we would have normally had. So there's a huge difference already there. Like, I mean, we're talking like what, $60,000 roughly difference between what's in there and what's not. And that's just in bonus depreciation alone. Plus you have accelerated depreciation on this 5 year property, and if it's bonus depreciation, not necessarily, right? But you're going to get that extra amount, right? Oop. I went back too much. So, I mean, and this is why it kind of looks like that because you're able to deplete if you do 40% and you're looking at it over a 5-year period, you're able to deplete a little bit more. So this is basically the amounts that you would be able to get with bonus depreciation and everything else on top. And when you look at it based off of the differences that you would have had between that one and the other one, it's about $60,000, right? So the taxpayer just freed up $60,000 of free cash flow. What can he do with $60,000? Well, he can certainly offset taxes if he has it elsewhere in his portfolio. That's another thing to kind of like maybe they sold a property last year. Well, and they still had another property on the books. Well, with how the passive stuff works, you can deduct enough there that you can offset that gain, that passive gain that you would have had in there. So it's kind of cool to look at that, as a planning thing, especially if you're in a position of a sale in 25, and they've got other properties available. That's a really cool, unique way to kind of say, well, you don't have to pay all of the tax piper right now. And from a study perspective, our ROI from a cash flow perspective, just utilizing a specific study is, I mean, it can be 18 to 1. It can be, I mean, the numbers are just crazy in terms of what it actually provides from value for the taxpayers end of it. And of course, we've got time value of money, a whole bunch of other things. I know it's a timing difference, but I mean, 27 years is a long time. So that timing difference is really good to see up front. And like I said, you couple that with a 1031 exchange, you couple it as you go on, you just keep getting bigger and bigger properties. Heck, I guess our president right now, he's was famous real estate developer, never had to pay a lot of money in taxes because he kept rolling that up, and possibly because he had a bunch of NOLs from other businesses and things like that. But I mean, that's the overall real estate strategy is you keep rolling that in these 1031 exchanges and you never really pay the piper. You just take out more loans, right? And in order to finance bigger and bigger properties and more properties. All right. So now we've got let's take a look at, say, a $10 million property. This is our commercial property example, right? $10 million outlaid, and we've taken on debt and all that other stuff. We've got at-risk basis, all that fun stuff. $2 million allocated to land, $8 million building to basis. And you can see, I mean, especially when the numbers get bigger, of course, the savings look bigger for sure. But we're talking about $1 million versus $3 million in terms of overall deductions, right? That's a huge disparity in difference here, right? Like being able to get that through that access to that extra, what, $2 million of deductions, and in a single year too. It's not just this, I mean, basically you can really compare it to 196,000 versus 3 million. That's a huge jump in your ability to plan and do tax planning around it, right? And so, when we look at the overall savings over just this is 5 years to be kind of conservative because we're talking about like timing differences, right? The 5-year amount is very significant, like $1.2 million in actual liability. So that's assuming a 30% rate because we can get 4 million, we can get, for like 4 million over these 5 years. It ends up being pretty distinctly advantageous to our taxpayers. All right, so now we're going to talk a little bit about how cost segregation works, right, and why we're able to do this. As I mentioned before, there's, you know, there's a bunch of, and this thing has been a planning tool for a long, long time. Yeah, I mean, you can see there's a bunch of different, like we kind of introduce, like what is makers, what is Section 1250. We really introduced makers with the Reagan Act, the 1986 Tax Reform Act, right? We introduced it there in 1986. We introduced makers, but then we started getting like case law saying, yeah, we use this. It's easy to do that. Like, I mean, we start getting case law getting stacked up. I mean, look, here's chief counsel advice, right? So I mean, essentially DOJ right here issuing saying like, you know, we've got, or I should say the IRS's internal kind of provision here, but it says, it acknowledges cost segregation as a valid tax planning tool. That was in, 1999. Right. Like, but they've been using it a little bit here, for a long time. They've been issuing passive group activity grouping elections. They've been doing a lot of cool stuff, and then we just have multiple reinforcements of this throughout this entire time period. Uh, I mean, one of the big things that came out was the final tangible property regulations back in 2013. That was where we get to deduct like the $2,500 or just, hey, it was a cost under $2,500. We're just going to straight deduct it, all the good, all the fun, good stuff, right? And they even had a, audit techniques guide that was issued in 2004. So that way they could actually go out and audit this if they needed to for whatever reason. It's just because it's so so such a unique component of it. All right, here I'm not as good with my Zoom. Tell you what, Brian, we if you have a question, you could put it in the chat there, and I'll answer it here. I'm not sure if I can just allow you to talk, to be honest. Um, but in any case, I'll just keep moving here. But lots of cool stuff, lots of ways that has been reinforced over the time period, especially when you think about how like we have audit technique guides, we have a lot of things in there that really kind of show it out there. What they say specifically is the most reliable and accurate cost segregation studies are performed by construction engineers who inspect the property, review blueprints, and use actual cost data when available. And and that's why that's part of the reason why we employ actual engineers through this whole process, is because we want to know that, hey, if there is if there's an audit or something like that, we want to make sure that what we're doing is hitting exactly what they're looking for. And how do we discourage them like getting too in depth in it, or doing, messing around, like, all that fun stuff, right? You want to just make sure you're doing things as above board and as close to what they're looking for as possible. And if you see a statement like that, you go, all right, that's what they're really looking for. That means you're more likely to get just kind of a pass if you've got the right people on and the right professionals on with that meet the right criteria. Um, and so there's clear legal analysis and citations, like I've said before. I mean, Section 1245 to Section 1250, the Hospital Corp of America really established I mean, this is an A-OK way to go. And like I said, I mean, if the general counsel is saying this is a valid planning strategy tool, then it is, right? There's no getting around to the fact that it kind of meets all the criteria that you would normally have, right? And so, a proper study identifies and classifies individual assets into their appropriate maker lives. So a lot of times what they really want to see is, like a unique breakout of a lot of these different items. You don't necessarily have to keep it on your depreciation schedule. It's probably best if you do, so that way there's no issues with it. Like the way that we prepare it, we give you the list, like the long list of it, and then you can put in the individual assets the way that they're kind of broken out in there, or you can just put in a lump sum. I know that's easier from a practitioner angle, as long as you're saving your documentation in case the IRS comes. And we defend on any of these, without issue. It really hasn't been any like adjustments, if you will, for any of these as well. So like I said, it's a really valid planning tool. It's very difficult. Number one, it's difficult to audit. Number two, it's been acknowledged multiple times as a perfectly reasonable way to plan around tax liability. The other thing about the study is it must distinguish between Section 1245 and Section 1250. Allocations to land improvements, personal property, and building systems must be clearly defined. And then, there's essentially three methodologies that you could use. And engineering judgment, that's one of the reasons why we have engineers. But most of the time, in this unit in place method, that's a little bit more difficult to really make those allocations when you'll get invoices, and the invoices they don't necessarily match all of the stuff that was in place, right? Or they're not going to give you very detailed breakouts on a lot of that stuff. So when it says unit in place method, that's kind of how that methodology would work. But there's always hidden costs and hidden tangible items in a lot of that stuff. So what we generally use, and what most practitioners will use, is what's called the cost approach. And that's where they go out, like an engineer will go out and identify. I'll get into a little bit more of that, but you basically go out, you identify all the property on site, you build up a cost database for what it would take to do a replacement cost for any of these items, and that gives you a whole net overall cost, and then you can just apply percentages. And if you apply those percentages, you can get you can basically apply that across the actual purchase price or the actual basis price, and that's what allows us to we call it a squeeze, right? I mean, you're doing a percentage squeeze. You're figuring out what the new percentage is. And you're multiplying that against your actual cost basis, and that's how we derive essentially what's the 5 year, what's the 15-year property based off of our new assessment of replacement costs. And as I said, professional qualifications are important here. That's part of like the ATG thing. And like I said, the audit techniques guide thing, engineers are their priority. That makes it a lot easier for them to determine whether or not like a proper or a proper study was performed, and allows them to kind of give it a little bit more of a head nod if it's in that direction, right? And then but I mean, technically, we can do professionals with engineering, construction, or tax specialization. Like all these things can be used, but the most survivable thing is usually, utilizing engineers, and that's why we use engineers across the board, especially for like R&D credits and stuff like that. We're actually one of the unique ones that actually have engineers, which is surprising to me, given all those different scenarios. It makes it the most relevant, the best, usually the best run, like a lot of different things. I can't overstate how important it is to have engineers on a lot of these things because they really can dial down and get to a really good understanding of how things are relatively quickly. So, like I was saying, this is more of an elaboration on the cost approach. You stack it up. You say, okay, the engineer goes on site, right, and he goes, okay, there was 1,000 foot, a square foot of concrete poured, and he just like does a tally. Like there's this is these are the amount of cabinets and stuff like that on the property. This is the amount of like sinks, like this is the amount of like so they basically go in there, they take a lot of pictures, they identify the very unique kind of components, and especially the components there that would qualify for 5% amount. They enter all these things into a big cost database system. When you get that cost database spit out, if you will, right, it'll say a new value, like say it's worth $1 million now based off of all the replacement costs for all of these different ones. But hey, you might have bought it for $600,000 back 5 or 6 years ago. And so, you basically figure out what percentage was the 5%, 5 year, what percentage was the 15 year, and you can multiply that against the cost basis for the previous years in order to figure out roughly what amount or value we can pull out of the depreciable cost basis, not the fair market value cost basis, right? And so that's essentially how it works. And we usually move that into 1245 property, like dedicated electrical, specialty plumbing, things like that, right? Or section 1250 property, which is part of the building structure. That stuff, has to be 39 year, 27.5 year in general, unless it's one of those new QPP properties, right? Or we put it into land improvements, which that's the 15-year property, right? Which allows us to bonus those out. All right, final polling question. You guys have been so patient. Let me see here. All right, in that poll, you get a little bit more familiar with how Zoom works. All right, poll question number 6. How to identify appropriate taxpayers and plan to their advantage. This is where we start talking about what is passive, what isn't passive, where are we gonna, when we actually push everything down the line, are we gonna meet an obstacle? That's one of the things that, and that's one of the reasons why, one of the things that I do the most here is kind of look at it from a usability perspective. Are we going to be able to actually use these deductions, these credits? And there's always little things that can hold you up, like limitations for R&D credits. We got limitations on the 3800 schedule. You got limitations in a couple different arenas. You got AMT limitations, things like that, right? So when we flow this through the return, how is that going to affect us, right? And so we want to make sure that we find a taxpayer that it works for, right? And that we apply it in the right perspective. So this is one of the cool aspects. When I said, you can have a property that's way over a statute, and be able to utilize that property. I mean, it does deplete over time, especially if you got to like 10-year property or something like that. You might be more caught up than the bonus depreciation would kind of help. Like, and it depends on when it was done, too, like, because the bonus depreciation varied on each one of those years. That would be your calculated 481A adjustment. You're not going to get the 100% bonus depreciation of this year, right? It depends on the year in which it was actually placed in service. That would be the year that you'd be able to apply that bonus to. But we generally don't see, a lot of properties that are over 5 or 6 years old, but we do see we do see properties in that range quite a bit. And so the cool part is there's no statute here. I mean, like there's no statute on a change in method. What you're doing is you're doing a catch up because you're saying, hey, we should have done it this way in the past. We didn't have all of our information in hand, so we took the more conservative approach. And now that we've done a cost segregation study, we can take the more aligned approach with what is actually out there and available to us. So once you actually perform that, then you can do the 481A adjustment, which is just your catch-up deduction, right? And so you get to get your catch-up deduction all at once in whatever tax period that you're kind of looking at, and that will help adjust or offset, uh, a taxpayer's issues that they might have elsewhere in their portfolio. Now, I said, I mean, I made this clear multiple times here, but it's a timing difference, right? And so, if you sell it too, you got to do the recapture, all that fun stuff. But the cool part about selling it, if you use this 1031, you use a 1031 intermediary. I don't know how familiar folks are with 1031 exchanges, but hey, you use a 1031 intermediary, you get it all set up. You don't have to pay taxes on a new property. You're just rolling it into a new and larger property. If guy wants to take cash out on it, you can take another loan out, to get some access to it. But the cool part is you can essentially use this to kind of keep kicking the can down the road. If you buy a bigger property, you don't take out boot, you don't, and you keep it through this 1031 exchange. You can keep rolling that into more and more wealth for you. That's one of the real estate secret wealth winning principles, right? Almost everybody here, I'm sure, has probably read a book or two on real estate, in terms of how you can use that to build wealth for yourself over time. But it's really cool when you couple that with so like you have another property in your portfolio, you roll that out, you want to counteract it, you can do that. But the 1031 exchange is just really cool. Every single time you do it, you take on more basis or something like that you can depreciate each time. You buy a bigger house, you buy more houses. Like as long as that's considered, the like kind exchange or meets the like kind exchange criteria, you're good to go, right? One of the cool things about this, the cost segregation is best utilized with real estate professionals, right? Because we can bypass a lot of those passive limitation issues that we normally get with the automatic classification of real estate as passive. You can bypass a lot of that if you've got real estate professionals and you've got active participation. You can do both of those things, right? You get to take it 100% across the line. So those are really good things. And here's one that is so underutilized. I always get surprised about how this is, but we talk about self rentals all the time and how much money you're paying in rent to yourself and this other entity that you own. Well, most people work with lawyers when they're setting up their business entities, and the general legal advice is you want to group your real estate activities separate from your business or operating trade or business, so that if you end up in a lawsuit, they're compartmentalized, right? You end up with limited liability. That's the whole reason why limited liability exists. You want your limited liability to be limited to a property that's in there or to the active trade or business, so that way you don't lose both of them if you end up in civil litigation, right? So a lot of people are structured where they got their LLC, they got their property in their LLC, and then you got it structured to where you have your business in another LLC or S corp or something like that. If we didn't have these limited liability structures, they would be pulling in that property and depreciating it against their active trade or business income, right? I mean, it just seems patently unfair that they would that just by the fact that they had a separate entity, they're not able to take that against their active income when they're using it as a business operational asset the entire time. So the cool part is the tax code gave us this opportunity here to go ahead and group these activities together, and especially like when they're relatively insubstantial in comparison to the active operating trader business. like you see this so many times. Like, and when I was in practice, I had a lot of restoration clients and stuff like that, and they would own the business, and they were told by the franchise to own the building. Try to purchase the building separately in another LLC, you know, and there were so many people that underutilized this, but you can just group that together and take the depreciation against your active trader business income. They would do things like move it around, like add a little bit more rent here, or a little bit, like, I mean, you want it to be arm's length, but, I mean, so you could do a little bit of manipulation in terms of like, rental amounts from year to year, arm's length still, right? But you could do a little bit of manipulation there. But you like if you're in a situation where, man, we just had a bomber year, but I was stupid, man. I didn't think about, oh, I need to, take 30% and put it into a tax account. Well, this is a like what you would call a get out of jail free card if you get in a bind, right? And you see that a lot of times with medical and dental practice owners. They own the building that they're in. Hospitality businesses, I mean, they own the hotel that they're in, but they're operating a trader business, separately. Manufacturing, a lot of them will own the building, right? But they will separate that and coordinate it off from their active trader business income. And like I said, I saw that a bunch of times with franchisee and owner users. I saw that a lot. Um, and so you just make this passive grouping election, and now all of a sudden you can access all that depreciation that was held up in this entity, and you can use that against the active trader business income. A lot of practitioners don't really know that you can do that, but that's a great way to offset generated activity. I mean, a bomber year, right? That they weren't prepared for. So I always like to just kind of go over these rules. They're so complicated, right? I mean, they always get more and more difficult to kind of trace everything. I mean, we talk about Airbnbs. And I didn't put this in here. There's a rule that if the average rental is less than 7 days, it's not technically considered a rental, per se, but it can still be put on the Schedule E, right? Because so there's a lot that it went. Yeah, actually, let me talk about this real quick. So if it's less than 7 days, right, you get the opportunity you can either put it on the Schedule E or Schedule C, depending on whether or not it rises to the level of a trader business. Like if it performs, like if the person's like on site, like and they've got a bunch of Airbnbs and they're on site and they do the cleaning, they do all, but they provide services essentially for that are close to hotel-like services, if you will. You can put it on the Schedule C, right? But you have to meet all those criteria. There's a little section on there. You just kind of have to be more like a hotel, right? And that's really kind of how that behaves. Like you're providing services while they stay, that not necessarily, just kind of leaving it and then coming back cleaning up, right? And if it's between 7 days and 30 days, it changes the rule and criteria a little bit more, right? But well, a lot of Airbnbs are less than 7 day or average less than 7 day stay over an entire year. So you really more kind of fit in that weird window where most of them don't provide enough services to really be on the Schedule C. They actually belong on the Schedule E, right? But they're not considered a rental. They're not considered a rental, so they don't have the same passive requirements. Like if you meet the seven, so you can, yeah, like, so if you meet the material participation test, right? Like, and you're an active person on that property, you can essentially deduct more I mean, you can essentially not subject to those passive loss limitation issues. It's a weird kind of, you'd say that's another little loophole thing if you're trying to do some planning here for guys that own Airbnbs. That's something that you can kind of do. But the easiest one, like I mean, and we see this the most in practice, right? Is like these guys are, if they got a $10 million property, and they've got like another $5 or $6 million, these guys are real estate professionals for all intents and purposes, right? But you got to look at what are the real estate criterias that are out there. 50% of all your personal services performed in real property trader businesses or 750 hours, right, during the tax year. Those are kind of what drives that as being qualifying as a real estate professional. A lot of times I personally like to have like, oh, have they got a license? A lot of the things just like, or makes it very clear as day that that's what they're doing, right? And then one spouse must independently meet both of these tests, right? Um, and let me see here. So the other big thing too is if you're a real estate professional, you can group all these activities in a singular into a singular activity, which means that you can, like you're not going to be subject to like these weird passive restraints in one section or another. So I really do like the real estate professional, but you gotta go through the hoops, right? Make sure that you're meeting all the criteria and that you're making the elections, the proper elections here, saying I'm a real estate professional and I want to group all these and I want to do this aggregation election, right? And if the IRS comes calling, you must maintain contemporaneous time logs. That's one of the bigger issues there is that this is a contemporaneous documentation kind of component. So you do have to be able to provide that if the IRS does ask, right? Cost segregation, right? So the material participation tests, and like I said, this is one of those ones where you have to be like the problem is that real estate itself is by de facto, passive, right? So you have to look at you can meet the material participation test for the rental property, but that's not gonna make you unpassive. It's one of those weird things, like especially if it's just normal real estate. As you go through it, it's probably not gonna make you unpassive by itself, right? You have to like be like that real estate professional kind of thing if you to do both to do both things, right? So there's a little bit to that, and it really just boils down to when you're looking at that passive, it was 85, 82. When you're looking at the passive sheet, applying that, like you have to apply that. You have to look at the client as a whole. You have to understand how the passive rules work in terms of what you can free, what you can't free. And I mean, we do assessments all the time. So if you don't know quite exactly how to need to treat a particular one, and if you're just wondering if they have like the applicability of some kind of cost segregation, you can just honestly give us over like with the taxpayers permission, of course, like can give us over a tax return. We can just flow through it and say, oh yeah, you definitely got availability there. Or if you kind of know a little bit more about it, and you just want to ask a question, you can do that, right? With the bigger real estate developers, they basically most of them have to do this ADS thing where because they're going to have some sufficient enough interest, and they're going to be like what you consider a large taxpayer, which is the applicability of 163J. When I was when I was in BDO BKD 163 J meant a lot of different things. It was foreign. It was something about foreign stuff. I remember I had to do like some kind of foreign calculation for it, but then they kind of changed that with the Tax Cuts and Jobs Act, and now it's basically they force them to use the ADS system, right? Which is a little bit longer. Oh yeah, see right who like people who are over $30 million, you might want to take this like election, right? That allows you to kind of take if you put them into this ADS classification system, you don't necessarily have to worry as much about this interest limitation, but you're forced into using ADS, right? And if you're using ADS or you're forced into using ADS, then yes, I'll definitely be sharing the slides, Alex. Um, when you're forced into this situation where you have to use ADS, right? Like one of the cool aspects of ADS is you can separate out amounts. Like you would think, well, oh, well, you have to apply ADS to the lower levels. Well, there's a unique division. There's a unique position in there where you can still get the 5 or 15 year property, right? If it would have been otherwise considered 5 or 15 year property and otherwise allowable to take bonus depreciation, you can still take it, right? So there's a unique exception to that when you think about ADS, and QIP, yeah. Yeah, I'll just go past that. So, passive losses, we were talking about, all the fun stuff because most of us know that these guys, like, I mean, when you have interest, you've got depreciation, you might be in a tax loss regardless, right? You probably even got some tax loss already held up in the passive window, right? So, that's important to note here. If you already got it held up in the passive on the passive end of it. It's difficult to kind of figure out whether or not it's actually applicable. You want to make sure that um, you don't run a study on something that they won't have access to, right? And so you have to look at that. You really have to look at the 85, 82. You have to look at these passive loss rules while you're trying to figure this stuff out. Same thing, like with Section 179D deductions. I don't know if there's a lot of familiarity with Section 179D, but I mean, essentially you get like a deduction for like environmental kind of improvements, if you will, for like better HVAC, better lighting, stuff like that. You get a little bit of extra deduction for that stuff, which we do the studies for those as well. Um, but it's just something that really needs to be analyzed when you're looking through this and whether or not it really will help the taxpayer, right? So both of those, both 179D, if you own the property, right? And there's a unique exception for architects, engineers, designers of property for governmental buildings and stuff like that for Section 179D. But if you actually own the property, you're running a Section 179D study or you're doing a cost segregation study, there are timing deductions. If the guy is going to go out and sell it in 2 to 3 years, is it worth it right now to do it? Well, I mean, can we discuss doing a 1031? If not, you might have reclamation that particular year, right? So maybe you go buy at least another smaller property and depreciate against it. But that's why I say, hey, if you can keep rolling these into 1031s all day long, you can just grow your wealth. If you can take out cash as loans and stuff like that over that time period without necessarily running into a lot more tax type scenarios. And these larger real estate development guys, they'll look into these strategies when they know, hey, on one side of our portfolio, we're going to have a gain. On the other side, we don't want to push down so they'll work on leveling off what that looks like in a large like LLC partnership or shareholder or S corp shareholder stuff. They'll look at leveling that off across the board, and this gives you that opportunity to do it, right? So it allows you to do that extra tax planning around stuff. And a lot of a lot of those guys will just do it up front. So that way they just have access to the additional amounts if they need it. Although a lot of those individual taxpayers will have big passive carry forwards that only will get released at certain points in time. So it's important to understand how the whole flow works, right? That's always the biggest challenge for partnerships, S corps, all that fun stuff. How does this whole flow work? The best strategy, overall is to be classified as an active participant in the ownership of the property and be classified as a real estate professional. If you can do those things, right, you can get these ordinary income offsets without any issue, right? Unless we do the we have an active trader business that we're operating essentially in that building. We got the self-rental thing, right? So that's really cool thing. And then, larger scale partnerships can also be set up to allocate more active loss to active partners that may benefit, right? So you might have somewhere there's just a little bit, there's a few active partners, right? But they've got like a large, massive pool. So that's another kind of strategy that you'd want to look at. Like, can we use this? Would it be unfair to the other taxpayers? But, that's all guided by Section 704 and the partnership agreement. It depends. Like you got guarantee payments coming in to specific owners, that might be something that you want to look at, right? And then certain individuals with lower AGI, you actually see this quite a bit with say guys that and they're active, like and they're essentially active, right? You get to take this $25,000 loss. So they're really, I mean, there's not necessarily that window on it if you meet the activity kind of thing. Even though it's de facto passive loss, they do give you an allowance here of $25,000 if you have a lower AGI lower than 150,000. So you can essentially offset some of your losses there if you work on it. And it really does happen a lot because like these guys will be retired, but they've got property that's worth a lot of money, but they don't necessarily make a lot of money per the books, right? They still get Social Security that's untaxed. Like I mean, I've had that happen. I know some of you guys have that, right? And so I said, before I kind of went into more detail there about, short-term rental ownership like Airbnb, when that could be classified as like Schedule C, right? And then allows you a little bit more levels of deductibility. So, and now we're kind of getting just the tail end here. I think we've covered at least it is a 2 50-minute hours, if you will, from a CPE perspective. So I think we've reached our parameters there, just to give you guys a little bit more of a high level overview of what the benefits are of partnering with an expert in the industry. I mean, we not only do we have, myself, we've got, a bunch of other CPAs, we've got enrolled agents, we've got tax attorneys, we've got engineers. Like I said before, we're one of the only firms out there that really has engineers in this industry, which I mean, it mind boggles me because I don't understand how you could have a good protected study without one. But in any case, I know that a lot of CPAs out there, they worry about, this is my thoughts on it. Like I never really performed a lot of these, even though I knew we could do it because I kept going, well, who do I know that offers cost segregation studies? Well, BDO, and I don't want to refer my client to them. What if they want to take my client? Like they can't because they do those taxes, they do the core services that I offer, right? That's the cool part about you're working with like a company like Corporate Tax Advisors is that we don't we work hand in hand with you. We're a supportive structure. We're not like we don't do any of the tax preparation. We're a consulting firm, right? We're not a CPA firm. We don't do preparation. We don't do the books. We don't do any of that kind of stuff, but we do have experts that understand how all that stuff works, right? And the cool part is we want to function for most CPAs as an expert arm for them, right? When do we need to bring you in? And the way that we run the show and everything like that is, it's all deferential to the CPA and especially the CPA that brings us on board through this whole thing. But there's cool things, right? You can get like you have better client retention because you're now offering stuff at the level that you would say big four mid-tier firms can offer. You might be in part of a smaller firm where you don't necessarily have access to a lot of those individual specialty capacities like cost segregation studies, 179D studies, or R&D credit studies, stuff like that. And then also you might not be wanting to get into any kind of level of audit defense for these complex strategies, right? And that's why we have, CPAs, engineers, tax accountants, all that fun stuff, right? To fight the IRS if they come calling. Thankfully, I don't know if you guys have noticed, but the IRS is crickets as of late. So there's been a lot less of them around, a lot less of the IRS agents around as of late. And it also, it means like, additional revenue, right? You can provide extra hours of consultation, and then like we've got the CPE that we offer here. So there's a lot of different reasons why you might want to partner with a company like Corporate Tax Advisors to do any of these types of things. And that's the little bit of the sales spiel, if you will, right? Now, in terms of tax credit and incentive production process, like if you guys were to say, hey, I do have a taxpayer or two that we could probably go ahead and flag for you and see if we can bring them on board. Well, I mean, if it's just about like, hey, if you want to just give us high level details, what normally happens is we do preliminary analysis, right? So, if we get access to, tax returns and we get access to or just even the depreciable amount that we're looking at, place in service dates, or just even a blacked out depreciation schedule. We can do a preliminary analysis where we can tell you exactly kind of what that deduction level would look like. Of course, we don't know how the whole flow through works, and if you need some consultation on that, we're here for you. But that's for cost segregation, and then with the research and development credit, we have entire teams devoted to this. We've got PM, like we've got project managers, we've got multiple layers of review that go through this whole process. We got the engineers that gather the data, all that really cool stuff. Like what we do in the preliminary analysis is we kind of give you the amount that we're projecting. It's a conservative amount, right? But it's like here's what your possible credit looks like, right? Your R&D credit. If we didn't do it for the last 3 years, our experience in it says you're probably going to be around this percentage, and that percentage is conservative, right? We end up usually getting better than what we provide in a preliminary analysis, but it gives you a really good idea of exactly how much money is going to be going in there, right? And so the other thing too is, so once we actually give that preliminary analysis, then you kind of know, hey, this is what we're going to expect. And then we bring in the whole team, right? So there's introductions, like we do the instruction and documentation gathering, especially for like R&D credits and stuff like that. And then on, cost segregation end of it, It is, yeah, I mean, we've got that down to a science now, guys, where, we'll get somebody out there on site. They really like the taxpayer really doesn't even have to do that much. They have to give us like an address, like the basis, and pretty much that we can do a lot from there. It's very minimal. It's very minimally invasive in order to get these cost segregation studies done. They're just like they just schedule a quick on-site thing where they go and take pictures, get everything together, and then and that's it. It's actually so minimally invasive. We've got it down to a really good science is what I'm trying to say. Now the R&D credit's a little bit harder, right? Because we got to go through interviews, we got to talk to the right people, we got to get all that stuff together, right? And that's where we go through that process. And they have a whole team, that works with the taxpayer through that whole process. And then we get to the actual final study delivery and credit retrieval, where I mean, what's given to the taxpayer is this is what your study says. And then you just apply it in the tax return at the appropriate spot, right? You'll get a 67, 65. You get like whatever it is that's necessary, like the elections and stuff like that. We can basically funnel a lot of that stuff through, and you just put it into the tax return. That's the cool part from a tax preparation perspective is there's not so much to do after that point, and you've got justifiable work that you can go, you can say, hey, we're going to go ahead and um, uh, I mean, we know that we've got perfectly audit defensible work. I know we've got fatigue here. And then, like I said, the big thing is we back everything up with audit defense. So we've done quite a bit here today. That was a long 2 hours worth of, um, I know, tax nerd fun for most of us, right? Let me see. How do I stop sharing this? There we go. Okay, let me see if I have. All right. Do we have any other questions? I know that I saw somebody raise a hand there, but I don't know how this thing works. So I'm not gonna lie. Is there any other questions or anything like that before we wrap up this session? Oh, okay. Thank you guys so much. I really do appreciate you. And if you do have any questions or anything like that, like you'll be seeing my email come through with the CPE if you've stayed for the entire time here. And you should be getting some materials as well, right? So I'll give you the slides too. Um, like I said, I think you'll get some. You should be getting it between like 5 to 7 days or so. But hopefully I'll get it a little bit earlier. I know we might be getting closer to crunch time, right? I know I had to get a bunch of CPE done. All right, thank you guys so much. You have a wonderful day. Appreciate you. Adios.